Hello ladies and gentlemen, thank you for tuning into the Ascending Abundance YouTube channel. My name is Pavel Sverdlin, and on this channel I explore various strategies on how to make money with the existing capital that we got through real estate, crypto, stocks, bonds, business, anything that comes my way. I am a CFA and a CPA, but I'm not a planner or the advisor, so please do your own research. And today, coming back from a vacation in Portugal where we took our kids and just kind of enjoyed 8 days of travel through Europe with private guide and restaurants and just nice staying in Airbnb, my resolve to make even more money with my money is even stronger. It's those nice little things that we can afford with the money that we got that makes me even more interested in this topic of creating more wealth for my family, as well as sharing with anybody who is willing to join me in this journey. Recently, the stock market has been volatile. I'm looking at time between roughly middle of July all the way up to today, end of October. This is roughly 20th. So it's been volatile, it's been down, but it hasn't been that much down. Like we're looking at 7.5% reduction for, I believe this is S&P or and then 8.3 Nasdaq. I'm not sure which one's which, but either way, it's 8% is no big deal. Happens all the time. I am somewhat expecting more of a drop. I don't think we're done. I don't think this sell-off is over. One of the reasons is that M2 money supply, which we have researched recently, and if you check my video, there is a 90% correlation between M2 money supply and stock market returns and overall risk on situation. So the M2 money supply has been down for a while. If we look at this year, maybe increase it a little bit. So it's down precisely from July, and you can see that the stock market has also been down since July. So M2 money supply is the indicator to watch. And the reason it's been down is because the Fed is no longer reinvesting in treasuries, China is not reinvesting in treasuries, Saudi Arabia is probably also not reinvesting in treasuries, and interest rates are so high that the private sector and the commercial sector is no longer taking out as many debts as they used to at lower interest rates. So the overall lending in the economy has gone down. We don't have September data, we don't have October data. The best we get is August, and I'm waiting for about a week before we get the updated September figure. I am expecting it to be even lower, to kind of continuing the downtrend. So volatility though has not been too high. So looking at VIX, and I have wonderful VIX strategies, but VIX, you could see this dotted line is only 21.7, which is actually higher than it was in the recent months. But historically, that's no big deal until VIX goes up to 30, 35, well, anything above 30 basically, does not make me trigger any of those VIX strategies as yet. So I'm just kind of sitting on the sidelines, expecting more market volatility. The market again has been down just kind of a little bit. Before that, we've seen a nice run up all the way up till the middle of July. So really, there's nothing to kind of mourn about or whine about. Like we had very nice rounds, so this is all looking great. What would I be starting to look at these days? So looking at fixed income. So if you know this person, Howard Marks, who is the owner, or at least the bigger representation of Oak Tree Capital. Howard Marks is a renowned investor in bonds and private equity and mostly in the credit markets for the last 50 or so years. His memos are being read by Warren Buffett. I watch and read about Howard Marks as much as I can. He's a very bright individual. And in his recent memo, he talks about starting to allocate capital to credit. The interest on bonds is now quite high. It's higher than it's been in probably a couple of decades. The opportunity to make decent returns has definitely increased. Some of the dividend stocks are no longer as attractive as they used to be. compared to the US government debt, compared to the private debt. And if you look at distressed debt, then where Howard Marks is an expert, that's where probably the most opportunity is, but this is not my niche. I know very little about distressed debt. So what I try to look at is Ray Dalio's optimal portfolio. You can just Google Ray Dalio, and he's been featured by Tony Robbins. This is where this kind of portfolio comes from. But Ray Dalio is the biggest hedge fund manager out there. He manages wealth and sovereign funds. You gotta have $5 billion to just become his client. He's got hundreds of billions under management, pension funds, all that. And Ray Dalio's portfolio is allegedly one of the best in the world. He achieved mostly positive returns even when the times are horrible. His fund is still returning good money, and when the times are good, his fund is returning even more money. Very steadily, kind of retirement type, pension fund type investments. And he's recommending that investors hold a large position in long-term bonds and intermediate bonds. So if you sum those up, so 40% in long-term bonds and about 15% in intermediate bonds, make it 55% in bonds. Now when you look at bonds, again, there are long-term government bonds, there are corporate debt, there's intermediate, like 10 to 15, 20 years bonds. There are private bonds of various corporations that you can look at. I'm no expert in it, so I looked at the companies and the instruments that were kind of available to me. So this is a representation of how some of the companies and instruments been looking alike, and it's fairly bad, right? So PIMCO, 15-year US TIPS index fund. So TIPS are the Treasury inflation protected securities. So those are US government treasury bonds that have a 15 years to maturity, and their interest on them is adjusted to inflation. So this fund is pretty much guaranteed by US government. I don't know if it's good enough to these times to invest in US treasuries necessarily, but they're definitely way more appealing than they used to be. The interest on 15-year US TIPS is now about 4%. That is fairly significant. The government debt had not been yielding so much for years and years. If we go back to a smaller or reduced interest rate environment, we go lower from here, and then those TIPS are going to go up in value. In the meanwhile, if you look at the past year or so, LTPZ, which is a PIMCO 15-year US Treasury TIPS index, is down 20%. That's a lot. For US government debt to be down 20%, that's a huge discount. And if we go back, maybe we unwind, let's say back to 2021, we're looking at LTPZ losing 42% of its value. I know interest rates were way lower, but 42% decline for government debt, inflation protected, that's huge. So if you ever want to go back to Howard Marks or Ray Dalio's approach, then LTPZ could be the way to go. The other securities that I'm looking at, and I'm actually adding this to my portfolio, and I've already purchased some, and I'm thinking of adding more. So the other one is R, which is Alexandria REIT. That is not a debt, but it behaves like that because REITs are stable, dividend distributing companies. They flow through lots of their income back to the shareholders, and they behave and act like debt instruments, more so than their equities. R, Alexandria REIT, you can look at one of my previous videos on my channel. I've looked at it. I think it's the best REIT that when it comes to commercial real estate, because they're not really commercial, they're housing lots of pharmaceuticals and life sciences buildings and campuses. Those are not going anywhere. Alexandria REIT had locked their interest for their mortgages for at least 3 years, all the way to 50 years. They're insulated from recent interest rate increases. I think their portfolio is stable. In the meanwhile, this thing is 45% below its recent price, and that's a huge entry point, and the dividend yield on your investment will therefore get you so much more interest than it is. I believe Alexandria REIT is trading at above 5% dividend yield right now. We can look at it. Our dividend yield, annual quarterly. This is not it. Thank you, Google. Dividend yield, Alexandria REIT. REIT. I do apologize for not pulling this up ahead of time. I should have thought of it. So 525, and this is increasing every year. So every year Alexandria REIT is increasing their payout. So back here, so LTPZ and R, so US government debt, and the REITs are great opportunity. If you think about what the future is going to bring, so let's say 6 to 12 months from now, interest rates are probably going to go down. All the interest paying securities are going back up in value. Unless we see some sort of dire, horrible scenarios, these instruments should recover. In the meanwhile, they're paying you roughly 4 to 5% dividend or interest, and that's not shabby. Plus, you can overlay it, if you'd like, with the covered call strategy to just sell call options slightly above your purchase price or way above your purchase price and collect those premiums. Easily could make double the interest and increase your yields, double your existing yields. And then finally, not a debt instrument and not even a low price like I would expect, Royal Bank of Canada. So Royal Bank of Canada is the biggest bank in Canada by market capitalization. It's huge. It's probably top 20 worldwide banks, or maybe at least top 30. I don't know. I should be double checking what I'm saying. But it's humongous, and it's stable. It's safe. I know they're increasing their provision for credit losses. I know that the revenue growth is kind of stagnating because people are not taking as much loans, they're not borrowing as much, but we've seen this before. It's a cycle. Royal Bank is trading at, so Royal Bank ROI dividend yield just under 5%, which is huge. The rule of thumb is buy Canadian banks if their dividend yield is about 4%. Now we're at nearly 5%. Again, the bank has been increasing those dividends year after year for many, many years. It's stable. It's a monopoly here in Canada. It has operations worldwide. It's just a phenomenal investment. Has been for decades. Not to see it never go belly up. Not to see it could not go lower from here. But we're looking at the price that has been stagnating for many, many years. Like, let's go not maximum, but you're probably getting it at the same price as you could have gotten as 2019. So like 4 years back, roughly. Even go back as 2018, so 5 years. For the last 5 years, the bank has not made any progress on its share price. In the meanwhile, the dividends have been growing. The portfolio has been expanding. So this is fantastic. The price earnings ratio, as you can see, is 1074. I have not double checked it. I don't have complete confidence in these numbers unless I calculate them myself, but I do know it's fairly close to accuracy. So at 10% PE ratio, at dividend yield of nearly 5%, Royal Bank is probably a steal of a deal. And it's down another, 15% just in the 2023 alone. That gives you additional margin of safety to protect your investments. So among these three companies, you're probably getting about 5% yield. You could be using call option overlay. You're just waiting for interest rates to stabilize, kind of markets to come down, the yields to kind of recover, and the Fed to start cutting rates. If you're not inclined so, or if you believe that, let's say, NASDAQ is going to recover even more faster, if S&P 500 is your way to go, then maybe you want to wait a little bit before putting some money in there, just because I don't think we're done. I don't think we're at the point where these massive funds are at their bottoms. So going back to S&P 500 and comparing that to NASDAQ. So let's add NASDAQ. I don't think we've seen the lows yet. I don't think this has been the kind of the best kind of the entry point for them. I don't think we've seen the bottoms. Whereas on some of the securities that are down by 40%, 15% even for Royal Bank from the low level that it was, that may be an opportunity to buy some bargains at the bottom cheap prices, as opposed to try to pick up well diversified, well advertised, wonderful indices, but they're not down as much as I expect them to be yet. For these ones, we might have another 5-ish, maybe 10-ish% down, or at least flatness from here, because I just don't see them hovering at these high levels historically, given that the interest rates are still too high, the economy is not seeing sort of the impact on the interest rates fully as yet, and M2 money supply has not recovered yet. Where we're going with this, I believe, is that Federal Reserve and Federal Treasury are going to issue more and more treasuries, but they have only reverse repo facility balance, to pull this cash from. So the reverse repo facility still has roughly $1.1 trillion, which is down from 2.2. And if we look at how fast this has been declining, you could see that in July was more, so it might be June. If you look at June, there you go. So in June it was 2.2, roughly. Now it's 1.1. So we've seen a decline in reverse repo facility by a half. 1.1 trillion just gone in June, July, August, September, most of October. So 4.5 months, and this repos facility has been halved. That's really most of the cash that's sitting idle on the books, not being invested. I expect this repo facility to be drawn down, maybe not to zero, so maybe we got $1 billion at most, probably less, maybe $500 million more to go, and then these funds are going to be reinvested in treasuries. Question is, who is going to buy those treasuries after the reverse repo facility has been fully invested? U.S. government needs it. Federal Reserve is not reinvesting. China is not reinvesting. The interest on the U.S. government debt is also increasing, so more and more treasuries need to be refinanced. About a third of U.S. government debt is coming due within the next few years. So who is buying all of these treasuries? Other than the Fed, I don't see any other opportunity. In the next 3 to 4 months, we're going to see sort of the collapse of the treasury market without the buyers. The yields will just skyrocket and kill the economy unless Fed steps in. And I don't think they're going to wait for it. I think in the next couple of months, this is just going to become obvious. The overnight rates are going to shoot up. The kind of the protection and the insurance, the credit default swaps on U.S. treasuries are going to just shoot up. And at some point, Fed is just going to step in. Regular people are not going to even notice. It's just going to be a matter of a few days where Fed will just open up its balance sheet again, start buying those treasuries, calm the markets. They can easily print $1 trillion or $2 trillion in a matter of days if they need to, and all of a sudden we're going to have all of this liquidity. M2 money supply is going to start increasing, and we're going to back into the new cycle. I just hope they're going to conquer inflation before that happens, but we literally got maybe 3 months to go in this ordeal. In the meanwhile, these securities that I've showed you, the credit securities, I believe are fairly low as they are. LTPZ, R, Royal Bank. There may be others. It's just these ones I picked for myself. And I highly recommend you looking at them and starting to kind of dabble into it on the advice of Ray Dalio and Howard Marks, and maybe on my opinion as well, so that you can start building out some of those wonderful securities that will yield you in wonderful rates for many, many years to come, so long as you're willing to keep them in your portfolio and let them continue growing. So thank you so much for this video. I do apologize for skipping a couple of weeks. I've been on vacation, been thinking about what else to bring to this channel, and those are my latest thoughts on where we are. Thanks so much. Leave a comment, subscribe, hit the like button. See you in the next video.